If you want to learn how to properly manage big gap ups or big gap downs in the stock market, this video is going to be for you. My name is Pat Mitchell. I've been a professional day trader for the past 11 years, and I'm here to bring you high-level professional day trading educational content all here on YouTube and on X for free. So give me 1 sec. We're going to fire up these charts. I hope you all had a wonderful day. Let's do this. 1 sec. There we go. Okay, guys. So today we're going to be going over a couple of trades, one on SPY, one on Qs. Worked this multiple times. And where should we start? We will start here on SPY. Now, for those of you that are just joining us, these blue levels aren't struck after the fact. Like, this isn't showing you low of day or a range or a high of day and a low of day. These are all levels. These blue levels are all placed prior to the market open. So give me 1 quick sec. Sorry about that. There we go. Okay. So now that that's out of the way and you guys have a little bit of context, let's get into the actual trade. So I'm going to get zoomed in for you here on SPY. And generally speaking, so that you are following along, upper levels, if we were to open up here, and lower levels, the lower level is a long, the upper level is a short, and then we give our risk from there. Same thing here with Qs. That's kind of the basis of the strategy. Obviously, there's more to it than just that, but that'll kind of get us situated. So I'll get zoomed in even more, stretch this out so then you guys can see it really well here on SPY. So SPY and Qs, both at the market open, really shot up. So it shot up really quick, but it didn't quite give a perfect entry. Had to be a little more patient. So on SPY, that happened just so that first candle pops up, wasn't quite high enough. And I know this secondary one doesn't look like much, but when you're dealing with tight tolerances of risk and you're dealing with a lot of size, you do need to be very mindful of exactly where you're starting in. And I wanted to start in right here at this range. So I needed to allow it to come into that second candle as it pops up. I was able to get my entry, smoke that entry, and then as it pulled back into this level of support from pre-market, that's where I'm paying myself. Now, I still did have a few contracts left over on that, and then so I just continued to pay myself on dips, and then once we came back up to retest this level, that's where I entered on a secondary trade and then ran it all the way down and ended up being a pretty decent trade, especially for a Tuesday morning after a long weekend with a big gap up. And I'll go over some pointers and some tips here on gap ups and gap downs here in a sec. But walked in $5,388 on SPY and took essentially the same trade on Qs. You'll notice a lot of the times on both of these charts, now the execution may be different timed, but the trade is generally the same. So the same short on SPY is the same short I took here on Qs. Mind you, I was a little more patient because I was dealing with different risk parameters on Qs. So I wanted it right into that level. As it comes up into that level, I execute, add on that next push, and then simply pay myself as it comes down into that pre-market support. Pay myself. Very simple, straightforward trade. Again, it doesn't look like much, but this is almost a 2-point drop. And on options premium, this is going to be quite substantial. So locked in $4,799 in that. Now, a lot of people will get confused on gap downs. Let's talk specifically about gap downs. And they think that it has to sell off. And I guarantee, because every time I do videos on gap ups or gap downs, there's always some very inexperienced trader out there saying how easy the day was. Of course, it's going to sell off. Of course, you're going to go short. And it's like, that's not the case. There's been so many times in my career where huge gap downs, they get bought up. It's not necessarily a sign of weakness. What happens is if there is sometimes, not today, but sometimes there is a catalyst on the horizon, and during pre-market or after hours trading or overnight, there is a catalyst, and they can use low volume as a means to drop the stock into an area that institution would want to be buying, which is generally a level of support. Now, I'm not saying that happened today, but I'm just saying that is a potential and a possibility. That's why generally if we gap down into support, it will end up coming up. Now, there's lots of ways to handle this. And the easiest, simplest way on a big gap up or big gap down, because the only thing that we can control as traders is risk and manage our risk, size down. That's all you can do. Your best bet is to size down, allow the market to unfold, and be very in and out on your trades. Don't look for huge home runs. Don't look for a lot of follow through. Just execute into your first support or resistance level, and then pay yourself the majority of that trade, if not all of that trade, because most of you are trading small accounts, into the first support level or resistance level on the way down or up. It's basically execute, trade it to a target, get the fuck out, and that's it. You can always re-enter, but once you take that first trade and you lock in a certain amount of profit, your next trade has to be taken with less size, because you definitely don't want to turn a beautiful green day red, where I've seen a lot of traders, especially through the years on social media or even just in the room, where they will execute a secondary trade with more size, and then they just completely fucked up their day. And you have to ask yourself, like, well, why are you doing that? It's the exact same thing. And there's always seems to be this major disconnect in the stock market and money and what reality is. People use this as a means to gamble, which it isn't. If you're a gambler, you're probably, well, you will 100% blow up. It's a matter of time. So a lot of traders, instead of just protecting their account and protecting their risk, they try to overdo it. They're looking for so much range in that play when you simply don't have to. It's the same thing as if somebody handed you on the street a $50 bill, a $20 bill, a $10 bill, a $100 bill, doesn't matter, and you crumpled it up and threw it away, waiting and hoping for the next guy to come with a larger denomination of bill. It's the same thing. It's fucking stupid. That person that handed you the bill would look at you like you're fucking retarded. And that's how the market looks at you. The market looks at you like an easy mark fucking retard, because that's what's going on. So you got to stop doing that shit if you're doing it. As I said, the only thing that we can fucking control is our risk. So do it. And especially on gap downs, big gap ups and big gap downs, simply manage and control your risk through small size and duration of your trade. And that's really all it boils down to, folks. Okay, guys, I hope you all have a wonderful evening. If you want to learn how to come do this properly with high potential of actually getting there, come to tricktrades.com. If not, you want to continue chasing your fucking tail, that's up to you. Go and watch 1,500 free videos for you to slew through. But that's on you. Okay, guys, have a great evening. Adios.